In this video, we're going to talk about something called pro forma analysis. Pro forma analysis is a mechanism that can allow us to predict what our financial statements will look like next year. It can give us indications as to whether or not our strategic plan is working or not. What will the decision to pay off this long-term debt, how will that affect the rest of the balance sheet and the rest of the ratios? So we're going to be looking at how investment in new assets, financial leverage, dividend payouts, and liquidity, what do those things have to do with the financial statements in the future? So we're going to have to find some data. We need to have a sales forecast. Lots of places to get that. We can see what the percentage of growth was on an annual basis when we were looking at some of those beginning financial statements. I think it's pretty simple to go through that process, but we can use that ratio, those ratios, to do that. We can also maybe look it up in Yahoo Finance, Zacks. Lots of places might have sales growth estimates for companies. We're going to create these statements. They're predicted, they're projected for the next year or so. One of the things we need to know is what are the assets that we need in order to create the business that we think is coming our way. Once we know what assets we need, we then need to figure out what the requirements are to pay for that. Where's the money going to come from? We're going to use some plug variables to help us decide ultimately how to get the money that we need. And of course, there's always going to be some economic assumptions. So from an income perspective, we have to look at costs. We have to make some decisions on how we think assets are going to change or how things will change with income statement items. So typically, we're going to assume that most of the costs of production are variable. That just takes some of the complexity out of the financial statements. Depreciation and interest expense typically don't vary with sales, right? Depreciation varies with asset base. Interest expense varies with borrowing. So it's not going to have much of an influence on the gross profit margin or the operating profit margin. It will, but it won't have that much effect on those margin numbers. And finally, dividends are a management decision. So they don't change with sales at all. They happen after tax. On the balance sheet side, this is where we have to kind of understand how assets act, right? Most short-term assets and short-term liabilities are going to change with sales. That's where we get this percentage of sales approach. But things like notes payable, long-term debt, and equity, they're not going to change. They're dependent on where and when we need to get money. So ultimately then the change in retained earnings of equity is going to have an impact of not just the income statement, but also the dividend decision that we make. So finally, the last number that we look at is something called the external financing needed. This just tells us, excuse me, do we need to go outside the company to get money if we have a deficit, or if we have a surplus, how are we going to get rid of this money? We have extra money that we need to get rid of. So the external financing, this ratio, could be a little bit bigger, but this ratio that we have gives us, I'm just going to try to make this just a wee little bit bigger. 1 minus the total asset times the change in sales. This tells us if sales are going, assets are going to increase. And then we have to look at where's the money come from. We're looking for internal sources. So there will be some spontaneous liabilities that change directly with sales. So if sales go up, this number goes up. And of course, we're going to have to finance with that. In addition, we're going to have some retained earnings. This is the calculation for what retained earnings will be kept. And of course, again, the number left, EFN, just says we either have a deficit of money or we have a surplus. So what do we do with that stuff? What do we do with this information? Again, these models, they don't really tell us what things are best or whatever, right? They're just simplification of reality. They are a best guess of what we think is going to happen in the future. Now, there is a video on pro forma analysis and how you actually perform this for a real company. But I'm going to go through here and kind of just look at those statements just to kind of give you an idea of what it looks like to do this for an actual company and get away from that simplified formula there. So we have some data that we need to gather. This is information. We get all of this information from our financial analysis. Now, one of the things that we might do, so let's say sales growth historically has been about 5%. But if you look at the last 2 years of Disney's growth, it's been growing a little bit higher than it was earlier. So maybe we don't want to use 5%. Maybe say, what happens if sales is 8%? Our cost of goods sold, let's keep that the same. So whatever that average was of cost of goods sold, we'll use that number. And again, we just gather this information from our ratio analysis. So the very first year we indicated, we put in our first year's income statement, our last year's income statement and retained earnings. And of course, the data from the previous slide is going to predict the next year's income statement and retained earnings. So we have numbers that tells us what the numbers ultimately are going to look like next year should our prediction come true. We also have a balance sheet that's created. And in this course, again, here's where the external funds analysis comes into play. Retained earnings is already assumed. So if we need any more money, we're going to have to go outside the company. But in this case, what you see is we have $235,000 that we've gathered. We have this money, but we only need $154,000 worth of assets. So we have a lot more money than what we need. In fact, we have over $80,000 in a surplus. So external need, if we need money, we know we're either going to have to go to a bank or go to common equity. And this ratio tells us how we've done that historically. Historically, 57% is long-term debt, 42% is common equity. We need to do something with this $80,000. So we're going to pay off our debt backwards, if you will, pay it back with this $80,000 extra dollars. So here's our $80,000. We've decided to change our structure. So we want net notes payable, $50,000 for bonds, 35% for common equity. So this is how that's going to be paid off. Now we don't have notes payable. So this is a little weird because it actually says we're going to have negative notes payable, which means we are investing short term in these notes payable. Negative $40,000 will reduce debt by $40,000, reduce common stock by $28,000. Here's the cost that we get from these fixed financing charges. So that's going to show us how we ultimately pay this off. So now if you look at the income statement, if you add that together, right, we had $978 of interest expense, but because we're buying back debt, we're now going to actually convert that. So we're going to have about $417 worth of interest expense or interest income. So it's going to convert for us. But that's okay. We just want to predict what we think is going to happen. If you think about the balance sheet, here we go. Yeah, we're reducing the balances. So notes payable, we're actually investing $12,000 because we have zero. We have $68,000 of long-term debt. We're going to buy $40,000 of that. That's $28,000 is what we're left with, etc. Now, if you look down here, we had $80,000 surplus. Here's how we distributed that information. And now we're down to $982. So we're going to do this in this spreadsheet. It does it for 2 more iterations. So in the end, this number will be 0 or be very, very close. So that's how you get the statements. But what do we do with it? The first thing we can create, and again, this is all with this statement analysis spreadsheet, is you have 5 years of historical data, and here's the year we just predicted. It would be the 4th column of the pro forma analysis worksheet. So here's that 2020 information. We can then, here's our 5 years of historical ratios. 2020 year, this is a prediction. This is what we think will happen next year. What will be different than this year, right? So it looks here, liquidity is going to go up a little bit. It looks like as far as debt is concerned, debt is going to be reduced substantially, right? Because we're buying back debt. Our financial leverage multiplier is going to go down, right? All of these things kind of should make some sense to us as we think about our plan. Now, if something is really going the wrong way, you might say, hey, we have to rethink the impact of that decision, right? How is that going to affect the company? Not in a good way. So that's what this, for me, I think that's the importance of this pro forma analysis, is it says, look, this is what I want to happen. If what I want to happen does happen, what will the company look like next year? And of course, I can do this for several years. I don't have to have it just for 1 year. I can do it for several years. So again, there is a video for calculating pro forma analysis. That's it for this. Hope you had a good time. I'll see you the next time.